Hey everyone, Richard here. So in this video, I want to talk to you all about dividend tax for property investors. So if you're somebody like myself who started building a property portfolio in a limited company, then you're going to understand that there are two different types of taxes that you have to think about when building out the portfolio. One is corporation tax, which is what the company pays on the gross profits from the property portfolio. And the second is dividend tax, which is the income tax that you pay when drawing down your income from your property portfolio in a limited company into your own name as an investor. Now, if you're one of those people who's just thinking about starting to build a property portfolio and you're not sure whether you should be buying in a limited company or in your personal name, 90% of the time I recommend that my clients buy in a limited company. Now, I'm not going to go into the granular details of that in this training today in this short video. I have a separate video on my YouTube channel all around buying properties in a limited company versus buying properties in your own name. So you can go and check out that video after this one, and it's a really in-depth video that talks all about that. So with that being said, like in this video, I just really want to touch upon the main taxes around corporation tax, but mainly focus on dividend tax, which is the main kind of income tax that we have to pay as a property investor and think about when growing the portfolio. And even if you know what dividend tax is, like I'm really going to dive into it in the granular detail in this video today and in this training. And I'm basically going to talk to you around dividend tax is in terms of like the three different scenarios. There's three different dividend tax brackets, and I'm going to go through each one and I'm going to break down the granular calculations step by step, because I think that a lot of people have like a really high understanding of dividends, but they're not really sure on like how to work it out based on their individual circumstances and how much tax they'll be paying, basically depending on which tax bracket they're in. Okay, so this training is going to aim to kind of facilitate that and help you to answer those questions for yourself. And at the end of the training, my goal is that you're able to calculate you're able to calculate the exact amount of dividends in terms of the taxes that you're going to pay on the dividends that you withdraw, depending on which tax bracket you're in. So with that being said, for those of you who don't know me, my name's Richard Norris. I'm a successful property investor. I've built a multi-million-pound property portfolio, and my group of property companies does over 100k a month. So with that being said, let's dive into the training. So the first thing I want to talk about is just to give you a bit of an overview, and then we'll dive right in. So what are the property taxes that you have to consider when buying in a limited company? Now, the first one is when you buy properties in a limited company, there are two different types of taxes to pay, which I've already touched upon. But to reiterate, you have corporation tax. Now, corporation tax in the April 2022 to April 2023 tax year is currently 19%. In April 2023, corporation tax is due and set to rise to 25% per year, okay? So HMRC are throwing their weight around again, as they do, and saying, hey, you guys don't pay enough taxes, and are starting to try and make us pay more taxes, right? As they do. So the next type of tax that you have as a property investor is dividend tax. Now, dividend tax is basically the main tax that you have to pay as a property investor when you're drawing income from a property portfolio into your own name. So corporation tax is what the company pays on the gross profit from your property portfolio every year. Then once you've taken off the corporation tax, you pay dividend tax to extract those profits, into your individual name if that's what you want to do, and you'd be paying dividend taxes on that income, okay? And we're going to dive into all the granulars of that. So we're going to take a look at the tax calculation. Now, you're going to see there's three different tax calculations depending on which tax bracket you're in. So as a lower rate taxpayer, so somebody who earns up to £50,270 per year, your dividends are taxed at the lower rate of 8.75%. Now that's even gone up because they were around 7.5% previously, right? But as of the recording today, in the 2022-2023 tax year, dividends are currently being taxed at 8.75% if you're a lower rate taxpayer. So we're going to go into a tax calculation around that, and I'm going to break it down step by step in the granular detail so you can learn how to basically calculate this yourself, because dividend taxes aren't straightforward, and you're going to see that as we go through this video today. Then we're going to take a look at the tax calculations for dividends for higher rate taxpayers. So if you're somebody who earns up to £150,000 a year, then a proportion of what you earn is going to be taxed at the higher rate dividend tax of 33.75%. And again, we're going to touch upon the granular details as we go throughout the training today and do the tax calculations together. And then what I'm going to touch upon is the last tax calculation, which I'm going to run through with you, which is effectively how much tax do you pay on the dividends if you're an additional rate taxpayer. So if you're somebody watching this video and you earn over £150,000 per year, or you're somebody watching this video and you aspire to be earning above £150,000 per year, then you're going to be paying taxes at 39.35% on a proportion of those dividends, okay? And again, we're going to break it down because it's not as straightforward as 39.35% on the whole 150. You're going to be taxed at different brackets depending on the tax bracket you're in, and we'll kind of go through all of that together, which is exactly why I put this training together, okay? And then the last thing I'm going to take a look at is I'm going to show you how to extract £100,000 a year of income from your property portfolio through your limited company in the most tax efficient way possible. Now, I'm going to touch upon this just before I go into the granular details. The most tax efficient way to withdraw income from a property company is ultimately through a director's loan, because you pay no tax on that. And again, if you don't know what a director's loan is, I have another training under the property investment tax structure in my playlist, in my YouTube channel. You can watch that video. It's called All About Directors Loans. And it basically talks about how to, as a property investor like myself, how I draw income from my property portfolio completely tax-free. And again, you can watch that after this video. But there will be a point over the lifetime of your portfolio where you extract all of your director's loan, and then you have to pay dividend taxes, which is again another reason why I'm creating this video. And again, depending on who you are will depend on how big your director's loan account is, okay? So they all of these things kind of go together. Corporation tax, dividend tax, director's loans accounts, they all kind of form part of a limited company structure when you're buying properties through a company, and they're all things that you need to think about as a property investor. However, like I say, on this in this training, we're just going to talk about dividend tax and focus on those and the calculations around that, because it's still a very tax efficient way to withdraw the income, as you're going to see. It's way better than employed income. So let's go into the next part of the training then. So corporation tax. So what is corporation tax? Well, corporation tax is simply the tax you pay on the gross profit of your property portfolio when buying them through a limited company. And corporation tax for the financial year beginning the 1st of April 2022 is 19%. And as I previously stipulated, corporation tax is due to increase to 25% for the financial year beginning the 1st of April 2023. All right. Now, if you keep the income in your property business, you only pay corporation tax. So maybe you've got other income. Maybe you're somebody like myself who has other forms of income in the form of active income potentially. And those businesses are very profitable, or you have employed income, and therefore, like myself, you just reinvest your property profits from your rental portfolio. Then you're not going to have to worry about dividend tax, right? You're only going to pay corporation tax, and I'm going to show you how to calculate that in a second. But equally, if you're somebody who needs the money from your property portfolio because you want to replace your corporate salary, and you're in the early stages of building your portfolio out, then in the early days, like I did too, you're going to have to withdraw the income, and you'll withdraw the income typically through the limited company via dividends. Again, I'm going to explain all about dividends in a second. So if you extract income from the profits from your property portfolio, you'll have to pay dividend taxes in addition to the corporation tax. So firstly, you have to pay the corporation tax on the gross rental profits, which I'm going to show you how to calculate in a second. And then once you've paid the tax on the gross profits, your net profits become taxed at dividends if you withdraw that into your own name as income. So you can only pay a dividend to yourself through a limited company if the company is making profit. So in this scenario that we're talking about, we can only extract dividends if our property portfolio is making profit, right? Which it should be if you're doing things right. If it's not making profit, then you need to have a serious think about what you're doing, and you maybe need to get some more education or more advice around how to restructure things so that it does start making profit, right? Now, again, there's three different levels of dividend tax that we're going to touch upon. The lower rate at 8.75%, the higher rate at 33.75%, and then the additional rate at 39.35%. Okay, so before we go into dividends, let's quickly calculate the corporation tax so everybody's really clear about that before we touch upon dividend taxes in a second. Okay, so corporation tax then. So if let's say you have a property portfolio and you have 5 properties in the portfolio, and the rental income from those 5 properties is £100,000 per annum, right? and you have mortgages, and the interest-only mortgages that you have on the rental property portfolio across the portfolio is £30,000 per year, and you pay £12,000 a year in management fees to your letting agent to basically manage the properties for you, and then you roughly pay around £12,000 a year in maintenance. In this example, I'm using management and maintenance at 12% against the gross rental income. So that's the £100,000 times 12% gives you the management fees and the maintenance at £12,000 per year. Now, ultimately, those are the main costs that you have in a rental business. So therefore, what you do is you take your rental income as £100,000, you minus off the mortgage at £30,000, you minus off the management fees at £12,000, and then you minus off the maintenance at £12,000, and you're left with a gross profit of £46,000. Now, on that £46,000 of gross profit, the company has to pay corporation tax at 19%. So if you do 46,000 times 19%, you get a tax bill that the company has to pay of £8,740 per year. That basically means your net profit in this example is £37,260. Therefore, if you want to extract dividends out of your property portfolio, and these were the numbers, you have £37,260 that you can withdraw down on as a dividend, right? And you may do that in the form of salary plus dividend. We're going to talk about that in a second, utilizing your personal allowance. But ultimately, you can only pay yourself a dividend up to the amount of the net profit. So the maximum dividend you could pay yourself in this financial year, if these were your numbers through your portfolio, would be £37,260. You couldn't pay yourself £40,000, for example, because then the company would be showing a loss, and you can't do that, right? You can only take dividends if the company is making profit. You could take a salary to run the company, and then you could put employed income against it. You could put yourself as a £40 or £50 employed salary, but you'd be taxed upon as a under pay as you earn, under PAYE, and you wouldn't get the benefits of the dividends, and you would show a loss against the company, right? But for the purpose of this training, we're going to talk about dividends because it's the most tax efficient way to run the business. And as you get into building your property portfolio and understand more about how to run the accounting side, you'll understand that most people take a very small salary utilizing their personal allowance and then take the rest as dividend, okay? And I'm going to show you how to do that in the next slides. So what I'm going to do now with you is we're going to go over and we're going to run the dividend tax calculations, right? For the three examples, we're going to run it at a lower rate at 8.75% up to £50,270 a year. We're going to run the tax calculation to take dividends up to £150,000 a year, therefore at the higher rate. And then they're taxed at I think it was 33.75%. I said I'll double check that when we get into the video in a second and do the calculations. And then the last one, we're going to do the higher rate, the additional rate dividends, which are taxed at that 39% plus bracket if you take dividends above £150,000. Okay, so let's jump in. I'm going to go over to the whiteboard now, and I'll see you in the whiteboard, and we'll run some calculations. Okay, so let's come and run some calculations then. So we're going to run through these three different calculations. And the first calculation that we're going to run for the dividend tax is if you're somebody who's earning, say, up to £50,270 per year. So let's put this in here. So 50,000, right? £50,270 per year is the maximum you can take up to the lower rate tax bracket. That's the upper limit, okay? If you earn more than £50,270 per year and you take more than that as a dividend, then you will enter the higher rate taxpayer, okay? Now, £50,270 per year is I'll put here LR for lower rate. I'll put LRTP, which basically means lower rate taxpayer, okay? So that's the maximum allowance. Now, out of that £50,270 per year, we get a personal allowance of £12,570 per year. Okay, now this is PA, this is your personal allowance. Now, everybody is entitled to this personal allowance on this as a lower rate taxpayer up to £50,270 per year. Okay, when you're taking dividends up to that amount as well. Now, out of this, we can also take, not to confuse things, but HMRC like to try and confuse us, you can take £2,000 per year per annum here. £2,000 per annum, I'll take away the PA because it might confuse you. £2,000 per year as a dividend, Okay, now that dividend is tax-free. So we get a 2,000 dividend allowance every year, which is tax-free, and we get £12,570 of personal allowance, which is tax-free as well. So if we take the 12,570 and we plus the £2,000 a year of dividend allowance, we actually get a tax-free income of £14,570 per year, TF, tax-free. Okay, and that is our tax-free allowance. Now, how do we work out then if we were to take £50,270 per year in the form of dividends from the property company? How much would we pay in taxes? Now, by the way, when I'm doing these calculations, I'm not allowing for corporation tax. I'm just focusing on purely dividend tax. And at the end, I'm going to focus on the dividend tax versus the employment. Okay, so you can see which one comes out better. So basically, this is saying that the property company made £50,270 per year, and we can draw that now as dividend. So it made more than £50,270 per year because we have to take corporation tax on. So net of corporation tax, you're allowed to take £50,270 per year because we're assuming that the company made a profit big enough and has paid the corporation tax. So then we're left with the dividend tax to pay on the £50,270 because we want to take it as income. Okay, so you have £12,570 per year as a personal allowance, and we have £2,000 a year as a dividend, which is tax-free as well, which means that the total tax-free allowance every year that we can take is £14,570 per year. Now, if we want to take £50,270 out of the company as a dividend, we take the £50,270 and we minus off the £14,570 of our personal allowance, okay, which equals, and I have to put it down here because I'm running out of space, which equals £35,700. So what this is saying is that we actually need to pay taxes on the £35,700 because £14,570 of the £50,270 that we withdrew as income is tax-free. Okay, so then what we do is we take the 35,000. Okay, just push this back. We take the 35,700 and we times that by 8.75%. Okay, because remember from the previous slides, 8.75% is the tax rate on the dividend up to that upper limit of £50,270 per year. So if we do 35,700 and we times that by 8.75%, we're left with a tax bill that we have to pay of £3,123.75 per year. Okay, on that tax. Now, what we then do is we take the £50,270 and we minus off the tax that we have to pay, which is the £3,123.75, and we get a total net income, therefore, for that year of £47,146.25. Okay, so that would be what we'd take. So if we were to take £50,270 and we were to draw that from the property company into our own name, and that's what we took out as dividend, and using our personal allowance and our tax-free dividend allowance, we'd end up with £47,146 net into our pockets, and we'd pay the HMRC this £3,123.75 of taxes for that year. Now, just to put this into perspective then, right, for those people that are like, is property still tax efficient? I'm going to show you that property is very tax efficient, and period, if you do it in the right way in the UK, it is the most tax efficient vehicle in the world. And I'll stand by that substance with the multiple videos that I put on my channel of how you can save, how you can pay no capital gain tax, no inheritance tax, how you can transfer properties in your own name into a company, paying no stamp duty, how you can withdraw income from a property company via a director's loan account. And if all of those things went over your head, don't worry, I've got multiple videos on my channel. But you'll see, if you follow my work, that I believe that property is the most tax efficient vehicle in the UK, and it's one of the main reasons why I invest in property, right? Which is contrary to what some people say right now, that property is no longer tax efficient. Honestly, guys, being really honestly and prudent is just because they don't know what they don't know, right? Property is very tax efficient. This is going to prove this as well. So if we take the dividend out, now, if we were to earn in this year as an employee, okay, so if we're an employee in this financial year, if we were to earn and take home £50,270 a year, our net of taxes, we'd end up as a net income of £37,378.32 for that tax year. Now, the way I work that out, by the way, is I'm not going to do the calculations, but the reason why you pay more tax as an employee is because you have to pay your tax plus your NI, which is your national insurance, which is why it brings it down to 37,000. The other thing is you have to pay 20% as a lower rate taxpayer on the £37,700, which is the difference between the £12,570 of personal allowance that you get as an employee, but then you've got 37,700, which makes up your 50,270. On that 37,700, you're actually paying 20% as a lower rate taxpayer through employed income, as opposed to just 8.75%. So in this scenario, you've got a tax saving of what we do: take the £47,146 and 25 pence. That's what you get from the dividend, and you minus off what you get as an employee at £37,378.32. And I'll put it under here because, again, I'm running out of space. You will end up with a tax saving of £9,767.93 per year if you took all of your money, all of your income from your property portfolio. If you took £50,270 per year of income from your property portfolio as opposed to income as an employee, you're going to save yourself £9,000, close to 10,000, just under £10,000. You're going to save yourself a year. Okay, so in that scenario, it would make complete sense to set up a company. If you had no other income in your life, set up the company and pay yourself £50,270 a year out of the profits as a dividend, and you're going to be much better off than if you were an employee earning 50,000 ish a year. Okay. So that's like example number one, and that's how you'd work that out. If you have other employed income and you say it earned 30,000 a year, you would just run the tax calculation on your dividends on the 20,270. You do 20,270 times 8.75%. Okay, and that would give you you take the 20,270, right? The difference between the 50,270 and your employed income at 30,000 would be that 20,270. You'd minus off your tax-free dividend allowance of 2,000, which would give you £18,270, and then you times that by 8.75%, which would give you your total tax bill. So let's actually run that quickly now whilst I'm doing this video. We'll run that so we can see. So in that scenario, then you'd have £18,270 times 8.75%. You'd only pay £1,598 in additional taxes to your 30,000 taxes, whatever that is in employed income under pay as you earn. You'd be paying £1,598.63, if you round it up, of tax to withdraw that extra £20,000 of dividend to go up to the upper limit. Okay, so this is just like a general overview, because obviously I can't do everyone's personal tax calculation, and I should have said at the start of this video, so I'll make a disclaimer now. I'm not an accountant, I'm not a tax advisor, but I do understand accounting and some tax perspectives that go with property, right? So don't take this advice as financial advice or personal tax advice. You must go to your individual accountant who is qualified to give you personal accounting and tax advice and submit your self-assessment tax returns for you. But I want to give you an understanding of how to work this stuff out. So that's the first example, right? So example number two then. So in example number two, let's run this. Let's say that you were a higher rate taxpayer, right? So you went from a lower rate taxpayer and you went to a higher rate taxpayer, and therefore you wanted to earn up to £150,000 per year. And I'm going to run the calculation at the upper limit. So in this example, we're going to say that you earn the maximum, the £150,000 a year under as a higher rate taxpayer. HRTP stands for higher rate taxpayer. Now, obviously, as a higher rate taxpayer, you have to pay 33.75% on the dividends. But you're going to see it's not all as bad as it sounds. It's not all doom and gloom. You don't pay the 33.75% on the whole 150. It gets broken down. So let me do this calculation for you. Now, the only thing is with this example, and not just this example, but in real life as well, that if you earn over £100,000 per year, then when you come to take a dividend, you actually lose your personal allowance, okay? So the £12,570 per year of personal allowance that we get as a lower rate taxpayer, we lose that because we're earning over 100k per year in this example, okay? However, you're going to see it doesn't really make that much difference when you do the calculations. Actually, it doesn't really make a difference at all, to be completely honest, because you're going to see when I break it down here. So what we need to do is remember on the upper limit on your dividends is £37,700 plus your personal allowance £12,500 makes £50,270. So when you're taking dividends on that 0 to 37,700, right, this is taxable at 8.75%. Okay, so what you do is you take the first 37,700 and you say, okay, let's minus off the £2,000 dividend, because remember, we get a £2,000 dividend allowance. We still get the tax-free dividend allowance even though we've lost our personal allowance in this situation. Okay, now what we then do is we basically say, okay, 37,700 minus the £2,000 of dividend means that in the first tax bracket, in the lower rate, we pay tax on 35,700. So on the first 35,700 of our 150,000 dividends, we pay tax at 8.75%, right? Which from the previous example, you'll remember, is £3,123.75, right? Now, then what we do is you say, okay, we've paid the first part of tax, but we've still got a remaining outstanding balance. And how do we calculate that? Well, we take the £150,000 of your earnings and we minus off £37,701, because remember that 0 to 37,700, here. Remember, 0 to 37,700, you're only taxed at 8.75% as the lower rate. Now, we've already worked out our lower rate, what we're going to pay 8.75% on. So we have to work out the next bracket, which is £37,701 to 150,000. So we need to work out the difference so we can work out what we pay that 33.75% tax on. So we take the 150,000 minus off the £37,701, which gives us £112,299, okay? Now what we do is we take the £112,299 and we multiply that by 33.75%, okay? Because that's the tax that we have to pay on the higher rate of the dividend, and that is going to give you a total of £37,900 and 91 pence. Okay, then what you do is you work out, okay, well, what's the total tax that I have to pay? So what you do is you take the tax here of £37,900 and 91 pence and you add that to this £3,123 and 75 pence, and you will get a figure of, so let's do this. So total tax to pay is your 3,000, okay, £123 and 75 pence plus the other tax of £37,900 and 91 pence, and then that will equal, and I'll put it here because again I'm running out of space, that will equal £41,024 and 66 pence. Okay, so that's the total tax bill in that scenario, and it sounds a lot, and it is a lot, but let's be honest, living in the UK and having HMRC, we always have tax disadvantages, but it's working out legitimately how we can save the tax in the most efficient way. And this is one of the ways to do it, right? Now, what you then do is say, well, I've got £41,000 tax bill. So what is my net income? So if you were to take £150,000 then of dividend, you take £150,000, you'd minus off your tax bill of £41,024 and 66 pence, and you would end up with a total net income of £108,975 and 34 pence. So it's still not too shabby, right? It's still a good amount of money, and that's your net income after you've paid your taxes. And you're going to see here, again, it's a lot lower than if you were in employment earning £150,000 per year. Because if you were in employment earning 150k per year as an employee, of salaried income under PAYE, you would be earning net just £93,973 and 70 pence. And again, that's because you've got your national insurance contribution plus your tax to pay. Whereas you can lose your national insurance contribution that you have to pay if you do it through dividends. And I'm going to show you how to do that in the final slide when we're doing the when I'm basically showing you how to take £100,000 out of the property portfolio in the most tax efficient way using dividends. You're going to see how to do that in a second. So if we look at this example then, well, if we take the £108,000, £975.34, and we minus off the £93,973.70, so we can work out what is the tax saving against taking it as a dividend from a property portfolio versus being an employed income, you're going to see, earning the same amount of money of £150,000 a year, you're going to see that the property investor saves £15,000 and 64 pence is the actual number that you would save by drawing out £150,000 a year as a dividend from your property company versus earning £150,000 of income as an employee. Okay, now remember, as I said, this doesn't count for the corporation tax. This is net of corporation tax, these figures for dividend. Okay, so that's example number 2. So moving through this very nicely, we've done the lower rate taxpayer at 8.75%. We've done the higher rate taxpayer at 33.75%. Now let's take a look at the additional rate of tax. So if you're somebody who aspires to earn or is earning more than £150,000 per year, right? £150,000 plus of income, then any dividends you take are going to be taxed at the additional rate. ADR means additional rate of tax, and that is at 39.35%. Okay, and again, it's still lower than being a higher rate taxpayer, an additional rate taxpayer as an employee. Because an additional rate taxpayer as an employee, remember, you pay 45%, right? So let's take a look at this then. How do we work this out? Well, for this example, I'm going to say that you earn £200,000 per year, right? And again, we're going to take all of the £200,000 a year as a dividend from our property portfolio. Because ultimately, if you're anything like me, and you want freedom and choices in your life, you're going to want to earn as much as you can from your property portfolio to give you enough money to do the things that you want to do, right? And hey, maybe you want to earn less than $200,000 a year. That's also okay. But if you aspire to earn more than $200,000 a year, then you need to understand this tax calculation. Now, so remember, we have the first 0 to 37,700, okay, is only taxable at 8.75%, right? Then we have the next tax bracket, which is 37,701 to 150,000, okay, and that is taxable at 33.75%. And then we have the additional rate, which is basically anything above 150,000 that we take in the tax year as a dividend, is taxable at 39.35%. Okay. Now, if we look at this, then we're going to run the tax calculations, right? So they're the brackets. Now let's work out on this on this £200,000 a year of salaried income. We need to work out at each tax bracket what we pay, and then add that tax up, work out the total tax bill, minus off that our income of 200,000, and we'll be left with a net income. So let's go for it then. So remember, on the first 0 to 37,700, on the first 37,700 earnings, we can claim the 2,000 tax-free dividend allowance. So again, on the first 0 to 37,700, we take off the 2,000, okay, and we're left with 35,700 that we pay tax on of 8.75%, okay. And if we look at that, then in this bracket, 0 to 37,500, we only pay 8.75% on 35,700, which is your £3,123.75, right? Then we have the next tax bracket, which is 37,701, all the way up to 150,000, okay? And in this tax bracket, we're taxed at 33.75%, okay? Now, how we work this out is we take that, the difference between 150,000 and the 37,701, okay, if you remember. So we take 150,000, we minus off the 37,701, which equals £112,299. And you should remember that in the previous example, we already did this tax calculation. So we're just basically taking tax calculation 1, tax calculation 2. We're going to do the new tax calculation 3, add them all together, and you're going to see how to work out the additional rate, right? 150,000 minus the 37,701 gives you 112,229. That's the difference. So on that part of the tax, on the income, we pay 112,999. We times that by the higher rate tax bracket of 33.75%, and that gives us a total tax bill of £37,900.91. Okay. Then what we do is we look at the 150,000 plus bracket. Okay, 150,000 plus, and remember on the 150,000 plus bracket, we have to pay. Scrub that out. It's going to put a pound sign in there, but it's a percentage. £150,000 plus, we have to pay 39.35% tax on the dividend, right? So you can see HMRC don't make this stuff easy for us, right? And this is kind of why I basically made a conscious effort to learn it, and why I'm sharing it with you, because when I first started out, all of this stuff really confused me. So, but hopefully this isn't confusing you and it's giving some value. So 150,000 plus is 39.35%. So we take the 200,000, which is what you want, which is what you earned for that year. You minus off the 150,000, so we know in that tax bracket, above the 150,000, I've earned an additional 50,000. So that 50,000, therefore, okay, which equals 50,000, the difference between the amount above the 150,000 and the 150 gives you 50,000, okay? And therefore, on that 50,000, we need to pay a tax bill of 39.35%. And this is where it starts to get a little expensive, because your tax on that part is basically, £19,675, okay? So 50,000 times by 39.35% equals £19,675. So now what we do is we have to go and add up the three tiers. So we've got 19,675 at 39, based on the 39.35% tax calculation. We have got the so we've got the 19,000 there. Then we've got the just trying to work out where I am here. We've got the 19,000 there. Then we've got the 37. I shouldn't have rubbed that out. How do I undo? £37,900.91. And then the 3,123. So sorry, having a few issues with the iPad and the Magic Pen there. So just to repeat that so you understand, £19,675 is what we've got at the bottom here. We've got 37,991 pence, and then we've got the £3,123.75 that we need to add up. Okay, they're the different tax brackets that we've worked out. So when we run that calculation then to work out our total tax bill, we take £3,123.75. We add that to the £37,900.91, and then we add that to the £19,675 of the final tax bracket. So this is the lower rate dividend at 8.75%. This is the higher rate dividend at 33.75%, and then this is the additional rate of 39.35%. And if we add all of those up, the sum of 3,123.75 plus the 37,991 plus the 19,675 pounds, we end up with a total calculation of 60,699 pounds and 66 pence. This is the total tax bill that we have to pay. So then what we do is we take the 200,000, okay, and then we minus the 60,000, and I'm just going to do 670. I'm going to round this figure up here. I'm going to round this 60,699 pounds and 66 pence to make 6,670, which gives us a total tax bill of a total net income of £139,330. The 200,000 minus the tax we've worked out that we have to pay, which is 60,670, gives us a total net income of £139,330. Okay, so you can see in that example how that works, and as a higher rate taxpayer, what you pay on the income. Now, interestingly enough, and I'm not 100% sure, to be perfectly honest, why it works out in this way, and I think it's just because you lose the personal allowance, but as an employee, if you earn £200,000 per year, you earn £142,348.70 net, right? So actually in this scenario, in the dividends, you earn less by taking the dividends. So anything by £200,000 plus against the salary of a £200,000 employee, you're actually keeping less of your money, unfortunately, right? So in this scenario, then let's work out what that difference is. So if the employee earns £142,348.70 and the property investor taking the dividends earns £139,330, we are left with a deficit of £3,018.70 that we actually, on the higher rate dividends, we earn less money than if we were an employee earning £200,000 per year in that example. And it's just the £3,000 on the 200,000. Haven't done the numbers higher up when it comes 300, 400. I'd be interested to see what they come out with. Maybe you, having learned the calculations, you can run that model and see what that comes out with for yourself as well. But that's basically, guys, tells you how to do the tax calculations for a lower rate taxpayer, higher rate taxpayer, and additional rate taxpayer on your dividends. Going to jump over into the slides again. I'm going to wrap up and I'm just going to show you how to basically take £100,000 of income out of the business as a dividend in the most tax efficient way. And we'll wrap up the training. See you in the slides. Okay, so now we've done the calculations and got all of the hard work out of the way. Let's jump into the final slide. And I'm going to give you what would I do in this situation. So with my property portfolio, typically speaking, I draw all of my income out tax-free using my director's loan account. If I was somebody who had used up all of my director's loan account, or when I get into a position where I, eventually use up my director's loan account, which I don't think will ever happen to me based on how I do things. But again, that's another video in the director's loan account. You can go and check that out. But when you've withdrawn your director's loan account, like what would I do? If I was in that situation, I was drawing out dividends. Here's how I would take out the £100,000 a year in the most tax efficient way. And you're going to see this only really works if there's two people. If it's one person, you can do exactly as example one in the tax calculation I showed you. But if there's two people, this is what I would do. So I'll put Richard as person A, that's me, Daniela as person B, that's my partner, and then I put the total household income at the bottom. So let's start from top left, and we'll work from top left to top right. And then we'll work from bottom left to bottom right, and you'll see how this pans out. So first thing that I would do is you'd take a salary. You'd get your accountant to pay you a salary of £8,840 per year. The reason that we don't get you to take a salary of £12,570 per year and use your whole personal allowance as salary is because you'd then have to pay a small amount of a national insurance contribution. Now, to get around not having to pay national insurance, what we do is we pay a salary of £8,840 that you can see in the top left. And then if you scroll along to where it says personal allowance, you'll see that the personal allowance, which is the fifth column in from the left, personal allowance at the top, we pay £3,730 as a personal allowance to us as a dividend. And therefore, basically what that means is we take the £3,730, we add that to the £8,840 of salary. The salary plus the personal allowance of dividend that we took gives us £12,570 and saves us having to pay national insurance, right? So basically what this means is that if we take a salary of £8,840, we have dividends of £41,430 that we pay ourselves. and that gives us a gross income of £50,270. Now remember, we have a tax-free income on the dividends of £2,000. I've just explained out of the 41,430 why we take the personal allowance out of the dividend at £3,730. That means if we take the dividends at £2,000, we plus the personal allowance at £3,730, we end up with a tax-free amount of £5,730. Right, which means that the taxed income is only $35,700, and that's taxed at a rate of 8.75%. And if we take the $35,700 and we times that by 8.75, the total tax due for that financial year per person would be £3,123.75, which would give you a net salary of £47,146, not pence, pounds and 25 pence, which would give you a profit per calendar month net, which is £3,928.85. So this is basically just summarizing the tax calculation that we did in example 1, where basically you're trying to keep your tax in the lower rate tax bracket, right? Now, obviously $100,000 a year is like a higher rate tax bracket. So how do you do that? If there's two people, as I say, it needs two or more persons. So your wife, if you're married, or your long-term partner, girlfriend, boyfriend, whatever it may be, or it could be you've got a business partner, or it could be brother or sister, whatever it might be to you. If there's two people in the business and you're drawing income, and it's like a household income, so I guess it would have to be between like two people that live together, as opposed to any two people. So this would only work for two people that live together to create household income. Then what you do is you just split it across two people. And that's exactly what I would do, which means if you look at the bottom column that says total household income, you end up basically, if you just skim to the bottom right, just to summarize, you basically end up with a net salary of £94,592.50, which gives you a profit per calendar month of £7,857.71. That's your net income, right? Not profit, net income, which means that you're only paying £6,247.50 of tax on £100,000 of income, which like is a huge saving. If you're earning £100,000 a year in employed income, your net is about 60,000 a year, and you're paying taxes around between 35 and 40k a year as an employed person, right? So if you split this across a household and you do it this way, you're saving yourself like 30k plus a year in taxes. Multiply that situation across 10 years, you've just made yourself another £300,000 because you saved £300,000 in taxes, which means that your net worth is now £300,000 more. Again, why if you deal with taxes in a strategic way, it's not about how much money you make, it's only important how much money you keep, and out the money you keep that you can multiply is exactly why I say that, because that's ultimately how you're going to create long-term wealth. So hopefully that makes sense. If you want a copy of this slide, I can just put it as a PDF and I can send it you. So if you just comment in the comment section below, just comment me, I'll send you a PDF out. I'll get my team to send you a PDF. Any questions that you got, please leave any comments or questions in the comment section. I'll personally go in and answer those. Just to reiterate, I'm not a tax advisor. I'm not an accountant. You should take my advice as general advice, and you should basically speak to your personal accountant when it comes to your personal tax situation and get your personal advice from a qualified individual. Because obviously in these videos as well, we can't account for everybody's personal situation, but hopefully this helped give you a real granular understanding of how taxes work. And if you like this video, please click the like button. If you didn't like this video, I love you anyway. And if you want to see more of my videos, hit the subscribe button if you haven't already. Click the bell icon so that you can get notifications. We deliver multiple videos a week, so you can basically get notifications when the new content comes out. Thanks for watching. Be great, be resilient. I believe in you, and I'll see you in the next one.